Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. We're going to get down to it. We're going to start really educating everybody. This is very important stuff. If you can get this right, if you can get these market conditions right, I think we're going to have some of the largest commodity bull market moves that we'll ever see in our lifetime. Kind of like the 70s. And I know some people say, well, it's more like the 40s because we're coming from a declining interest rate environment to a kind of an upward interest rate environment. But we have a very interesting dynamic. In the beginning of the 70s, we had worldwide, well, not even worldwide, we just had in America, we had a peak production of oil. And what peak production of oil is we hit the peak and then we started to decline and we came into an energy crisis or shortage. Why I think this is a little bit different is we have an energy crisis right in front of us. It's happening right now. We've got electricity prices going through the roof in Europe, in China. We're seeing prices of natural gas, prices of electricity, prices of all these things going way higher. I think oil is going to follow it higher. I think uranium is going to have a massive bull market, bigger than what most people can even imagine. I don't think that it's going to stop with the crisis as large and as far-reaching as worldwide as it could potentially be. I don't think it's going to stop at $200 a pound. I think you could add a zero onto it maybe, and I'm not joking. I'm going to show you some charts here. I'll go over them. And one thing I really wanted to touch on in this presentation are the 10-year interest rate. And I know a lot of people think that interest rates can't go up. They say we have too much debt, but debt in itself is what's going to cause the interest rates to potentially go up. The fear of holding debt, the fear that it will not get repaid. And if they go to try to repay this stuff, which means that they have to print copious amounts of money, and I know people say they don't print money, it gets loaned into existence. I already know that. I know how the system works. Yes, they have to loan it into existence, and yes, more debt's going to be created. That's what a treasury bond is, and that's what the Federal Reserve is. That's what that swap is. The inflation into the system is either directly injected from the Fed through stimulus checks, or the thesis of the channel, it goes through the expansionary phase of real estate, which is a credit expansion or a leveraging up of credit with new loans against new homes. That is the thesis of the channel. So I'm very well aware that money put into the banking system doesn't get loaned into existence. But I guess people are not aware that when you have ever increasing amount of new homes, that is inflationary. That is a credit expansion and that is money creation. And I'm going to go over it real quick. I will show you that we have inflation. If we did not have inflation or if we had deflation, we would not have producer price indexes going up. And I don't want to hear this supply chain shortage thing because it can't be this far reaching. It can't be across all commodities. It can't be across everything that I look at. That is impossible. That is a lie. CP lie, baby. So let's look at this. This is the PPI. And what is the producer price index is basically the inputs for producers. And what we saw, and this is the 40s back here, 30s and 40s up to 50s. It went sideways for a little bit, and then we had another large move, sideways for a bunch, another large move. And basically it's basically the demographic and the real estate market interacting with the demographic, in my opinion. And I'll show you what that looks like on the next slide. But PPI rose during the 14s. This was under a gold standard way back before this. We got off the gold standard, and then it's got this large choppiness going up and sideways. The PPI just broke out of its consolidation pattern to the upside. It's right here. We broke this upper band, and we're probably going to go rocketing higher, just like the 1970s, just like the 30s and 40s, and before that. This here is a leading indication of inflation. Inflation hits commodity prices. It then goes into the producer price index and then gets into the consumer price index. So it's important to see the leading indicator in this thing is a breakout to the upside. The deflationist guys, if they were right, this would not be going up. Bar none, period, they are wrong. The chart says it right here. Now, could this move around all over the place? Yes, it could. But this chart is disagreeing with the deflationists. This is inflation and it's moving on up. That's why the Fed Reserve is scared out of their pants. That's why they admitted that it's not transitory. That's why they're doing taper. That's why they're going to do 3 interest rate hikes. And that's why they're getting on it, because they know that the M2 money supply tsunami is coming. And we've seen that chart. I don't have it in this presentation. We've seen that chart before where the M2 money supply goes vertical to 23 or 24%. That's going to convert into inflation. And it's ramping up. And that's where they're like, oh, here it comes. Boy, did they do something wrong. And you can see it in this PPI, the producer price index here. Looking at the housing starts, this is what drives your inflation as well. Instead of all that money printing, and it is money printing or money creation, it goes somewhere. It just doesn't vanish. The M2 money supply is in circulation. That money got into circulation. This is what's going to sustain inflation. Anything in a green sector, this green sections, is an expansion phase of real estate, and they're very large in its nature. This one wasn't as large because it didn't get all the way up there, but this guy is going to be a big boy, I think. Obviously, I don't know for sure, but I think, and it's aligned to be a big expansionary phase of real estate. 1970s, here's your big move. Gold accounted for it, went down. Gold accounted for this other hump. 2 big humps of expansion in real estate. What does that mean? It means in a fractional reserve lending system that money gets loaned into existence against ever greater assets in the real world, exchanging money into the hands of people through the real estate housing market cycle against new homes, which take new loans. The green is the new loans going into the system. Commodity boom, commodity boom, commodity boom. What does that mean? It means that inflation has an impact on interest rates, and interest rates has an impact on, guess what? Bonds and stocks. And money prefers to be in commodities and rotates back into commodities during an expansion phase of real estate. This is your data. This is what supports the thesis of the channel. This is what you really should be paying attention to in your investing. 1980 was the peak of gold after these 2 large ones. Big one here as well. Peak of gold was just after, as they were trying to do a reflation trade after the crash. The market had it wrong. Yeah, they created money, but it didn't get into the hands of people. It was blocked because they couldn't loan it into existence because of the real estate cycle. Now we're coming into an expansion phase where it's going to turn all green. And green means go. It means inflation. So inflation's coming. We're going to have higher interest rates. And I'm going to show you the ramifications of all this. Those circles I have on here are just the buy and sell points of our commodity to stock ratio. Commodities outperform stocks. You go and buy stocks at this point. Commodities outperform stocks. You buy stocks right after this crash in 2009. And then you buy commodities, and wherever this thing peaks out, it's probably going to peak out in 2028, 2030, somewhere in that range. 2027 to 2030 would be a good bet. And this is going to be a big move. We're coming from the lowest levels in this ratio ever, which means we have the greatest opportunity. It has the best risk reward that I've ever seen against stocks. Commodities do. And you can obviously see this against a lot of these other commodities. This is the uranium, a pound of uranium in gold grams. We are down in no man's land. If you take the black line, we're still cheaper than basically the beginning of the last bull market. This is still incredible value. And we're going to see insane revaluations of everything that is commodity related, and revaluations of stocks lower. And if they don't go lower, these are going to go massively higher. Now, this is what I'm interested in. This is the 10-year treasury rate. We've been in a 40-year bear market of interest rates. This was a bull market in yields going up. So rates going up, and then which started in the 1940s all the way to 1980, almost a 30, 40-year bull market in yields going higher. Then we had a 40-year bear market in yields, and then we're going to have maybe a 10, 20, 30, 40-year up in interest rates potentially. And I know everyone's going to say they can't go up, they're going to go broke. Well, you know what? They're going to go broke then. That's what's going to happen because the pressure is going to build. It's not just going to go away. They're not going to be able to hold this down. What are they going to do? They'll sacrifice the dollar and the dollar will go away if they try to hold interest rates down forever. That is their decision. I don't know what they're going to decide. It's either higher interest rates, which the market will probably force it, or their dollar goes away. Just like the Turkish lira. The Turkish lira is gone. Now, it's going to be a different dynamic. I'm not saying that this is going to happen overnight. I'm not saying that this is going to be quick, because all of those currencies are going to run into problems before the dollar does. And the dollar will, the index at least, will remain strong. But the dollar, I think, will lose value against commodities. And it depends on interest rates. And I'll show you why I think that. This is the 10-year yield zoomed in. It's an inverted head and shoulder pattern that's developing. Could this kind of come back? It could go all over the place, guys. I don't know the exact future, but I can tell you that we've got the pattern. It's an inverted head and shoulders. It wants to go higher, at least from this pattern. Doesn't mean it will, but I'm going to say it probably will. And it's going to mirror what this side does. So we'll see what happens here over the next few weeks and months. What I have here is the Sprott Physical Uranium Trust, and then I've got the 10-year yield in the orange line. Notice that the Sprott Physical Uranium Trust basically more or less mimics the 10-year yield. Do you see that correlation there and how this thing mimics the 10-year yield? What I am saying is that inflation drives the yield up. And this yield going higher rotates money into the very things that we like. I think that yields have to go higher for this to go higher because of this correlation that's going on right now, and because it forces people to move money from one or two assets that we're not in into commodities. Here's the same chart with the North Shore Global Uranium Mining ETF. Here is the movements of uranium ETF in the candlesticks. The orange line is the 10-year yield. Do you see a correlation? Now, the volatility and the size of the moves won't be the same, but I'm looking at the overall direction. Up and over, coming, shooting higher. There goes your higher move. Then we've been lower in the 10-year yields. We've been lower in the uranium. It's a fear on movement. And when people are less fearful, these are going to go up, and so is your 10-year yield most likely. Here's a very strong correlation. If you look, this is Centennial Resource Development and the 10-year yield. Do you see any patterns in this here? I see that it's almost exactly the same, roughly speaking, of CDEV and the 10-year yield, and how these movements are very strongly correlated. We have an inverse head and shoulders pattern. It's no surprise that we have an inverse head and shoulders pattern on the 10-year yield. And this movement is the same between the two. Here's the platinum to gold ratio versus the 10-year yield. This has been declining, and the movements, the overall movements, are roughly the same between the 10-year yield and the platinum to gold ratio. What does this mean? It means that we've been getting lower highs until we broke this here. This is a step change. This here broke its high here to make a higher high, and now we're trying to put in a lower low on the right-hand side here. The 10-year yield, I think, will follow, and I think the platinum to gold ratio will compress in favor of platinum over gold, because when we go into inflationary environments, platinum outperforms gold. And that would mean that the 10-year yield is going to go up in that market condition. Here's the platinum to silver ratio. Notice how it's correlated. Why am I a big owner of platinum and not buying as much silver anymore? Look at the 10-year yield and how these are correlated between the platinum to silver ratio and the 10-year yield. You could overlay this, and I know that it's a little bit more volatile, the 10-year yield movements versus the platinum to silver. But what I'm looking at is the general direction of the move. This declines, this declines. This comes up, this comes up. So if we go into an inflationary environment where yields go higher, I suspect that platinum will outperform silver and we're going to break out of this downtrend line. Seems very logical to me. This is copper to gold ratio. Notice how the movements are all the same. Some are overblown and some are not. But what I think's coming up is we're going to break through this. And I say that because we're seeing across the commodity sector all of these charts putting in patterns that are about to break. And this is the copper to gold ratio. And I think that this ratio will probably at some point break this massive trend line, and copper will outperform gold for some period of time. It did it last bull market in the commodity bull market. And I have a feeling that we're doing something very similar today, especially if yields were to go higher. Meaning that we have inflation in the system putting pressure on yields. And do we have inflation in the system? What was the first thing I showed you in this presentation? The PPI, which is a leading indicator of what the CPI will read. It's going higher. West Texas oil and the 10-year yield. What do you notice? They're correlated. This goes up, yields go up. We had a little consolidation period as this caught up, came back down, came back down, came up, came up. It's correlated here. See how correlated all this is? This is a fear. There's fear in the market. Maybe the moronic virus variant came out and they're putting fear. Could this pull back a little bit more? It could. It could. Here is the platinum to gold ratio on a long-term perspective versus the 10-year yield. And what is very important here is I showed you that 40-year downward movement in, I'll just go here. Let me go all the way back. This 40-year downward movement in rates versus this big movement up in rates. If this is a large movement higher, we're going to see some of these commodities go just absolutely ballistic. And I don't know, remember, commodities and like oil and all these other ones are the driver of rates. Rates don't drive it. They are the driver of it. They're the ones driving the inflation. They're the ones driving the PPI higher. They're the ones driving this higher here. The leaders are the commodities, which then this is the ultimate driver of all of it. The relationship of the demographic to real estate market and the loaning of that money is the driver of all of this. Here's the XAU to gold ratio. This is gold stocks to gold. Notice that, and then we've got the 10-year overlaid on it. Tell me that this doesn't look correlated to you. Now, when this reverses and goes on up, what do you think the XAU to gold ratio is going to do? What do you think the gold and silver miners are going to do when we get a big inflationary environment and this interest rate chases that inflation? You're probably going to see a massive move in the gold and silver miners. Massive. It's going to revalue higher and compress this ratio, which means that the gold and silver miners are going to outperform gold itself. And we have all of the chart patterns suggesting that will happen. Here's Crescent Point Energy, just to show you another one. Nice big shoulder head shoulder, which has the same pattern as the 10-year yield. It even has all of the same movements as the yield. And I'm not saying that they're going to move in the same volatility. I'm just saying that the overall direction is the same. Transocean Limited, another one, shoulder, head, shoulder, that is developing, and you can see the 10-year yield. Uranium Royalty Corporation, which is another energy company. Tell me that this doesn't look very similar in its pattern. Don't lie, you know it is. It's very similar. What about Encore Energy? You think that's going to be the same? Up and over, sideways movement, and a little bit lower in the 10-year yield recently, which is a little bit lower in Encore. It's the same thing. What about Renesola? When I was looking at those solar companies, and these things are going to be volatile, guys. You're going to have to, it's going to throw you around like no other. Downward motion in the 10-year, downward motion in Renesola, and then all of a sudden, boom, interest rates go up. This thing flies higher. Now we're in a consolidation pattern because of the 10-year yield. Inflation comes. This is trading like an energy company, which it is. SunPower, another one that's moving with rates. Even had the little up movement there and it came back. It's just incredibly volatile for these companies. Here's the Rare Earth Strategic Metals ETF. Notice anything here? Kind of a downward movement, a little hump, a hump, come back down, and now we're breaking out of this pattern to the upside. Could this come back? It very well could with interest rates. It could do a retest here and come all the way back and do a retest or a return move. Maybe it doesn't go all the way back, a full return, but it could pull back. But on the big picture scheme of things, these have massive upside potential. The risk reward is fantastic. Here's Piedmont Lithium. You wouldn't think lithium has anything to do with it, but here's the 10-year yield. See how this is all correlated? Tell me that doesn't look correlated. In the comments section, if you don't think that looks correlated, put down, I don't think that looks correlated. Because it looks correlated to me. Here's copper futures. You think they're correlated? Oh, they are. Coming on up, down, and then it got a big move lower. Now, it doesn't mean that the amplitude or the size of the move will be the same, but the general directions are the same. We've been going sideways here, and we're going sideways here. Now, looking at the United States inflation rate, we've got this big resistance line, 24%, 20%, 15%, and 11%. Are we going to come up and tag it? And could we break this resistance line? I don't know. We'll see. We'll see what happens here. But this is the inflation rate year over year. Looking at the Fed funds rate over inflation, we've got this really deeply negative real yield. And what's going to happen is it's going to drive this yield that at least North Star, I grabbed it from him, he thinks it's potentially going to turn around. I do too. Because it's such a large real negative yield. And we haven't seen this type of real negative yield ever. So I think it's going to really rocket ship higher. And that rate of change of interest rates could be a very large rotation of money in stocks and bonds, depending on how this interacts with each other. Because when they come to these low points, it really rockets higher here and comes on up. And remember, this was driven by the real estate market. These big humps. And here is another one that I grabbed, Producer Price Index. This is the one I started with. This one I grabbed December 13th. It's just rocketing higher, and we have this nice big break. He has a target of something way up here, just like we had a break of the Producer Price Index here and hit the upper trend line, low trend line, upper trend, low to upper. It's a big old move up here in the Producer Price Index. Means we have an inflationary period coming ahead of us. And this is the 10-year Treasury note yield. It says we may have a big problem here. It's a new paradigm, and that's what I usually say, of yields potentially moving higher. says a false breakdown on a pattern this size may very well mark a multi-decade trend change. This is known as a capitulation bottom. Completely agree with him. And we're probably going to see a higher rates from this point onward. And when you tie this all together, what this means, and it's not, when someone takes an opposing view to this, what they are discounting is everything that I just presented. They're discounting the producer price index. They're saying, oh, that doesn't matter. The CPI doesn't matter. The expansion phase of real estate doesn't matter, even though they're all correlated together. And then you have all these massive chart patterns that are developing in all of the ratios in terms of an inflationary environment coming, and in all of those commodities themselves, in the mining companies, in all of these things. They're all interconnected. The fundamentals that are driving under this market, the structural fundamentals, are causing these patterns and causing these charts and breakouts. It's not by happenstance. The technicals match the fundamentals and the fundamentals match the technicals. They're one of the same thing. We're looking at the fundamentals through technical analysis. And what you do is you take a large group and you look across and you say, does this support the thesis? Yes, 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 and yes. I can't find anything that doesn't. Go look at cocoa, go look at sugar, go look at wheat, go look at soybeans. They've got massive patterns that are breaking or are about to break. Massive patterns. And it's this huge consolidation over 40 years because of the declining interest rate environment and the demographics in the real estate market. All of that tied together. And what it's painting is a big coiling up. And that coiling up is energy that's built up. And that energy is going to release itself to the upside, in my opinion, at some point. Now, we've made major moves in the beginning of this commodity bull market. And what we did is when you look at Elliott wave, you have three big waves. You have a first wave, and then a consolidation period, a third wave, a consolidation period, and a fifth wave. And depending on the time frame that you're looking at, you're going to see different time frames. And the scales of these moves are going to be a little bit different in terms of the consolidation periods and whatnot between the big upward moves. We've seen leg one in the short term. On the big long term, we could be putting in the first leg of a third wave move. And what that means is the 70s was the first big up leg. The big consolidation period from 1980 till today is that consolidation period, the 40-year consolidation period. And then we're going to see big time move. And it's going to be a good long time. It's going to be a big paradigm shift in the markets potentially. That's what I'm proposing. And when you start looking at some of these charts, and I wish I had one, maybe I should have grabbed one here. You're going to see gold in the 70s take off. It consolidated. You have another big one move. That's the first leg of gold in 2000 to 2011. That's a big first leg, and then we could have this massive third leg that could potentially come. We could see downside in the very short term, but that doesn't negate the big, long picture. So the volatility in the short term, if we get pullbacks, and we could pull back more in uranium and oil and gold and still be in this massive bull market on the big picture macro view. We're just in a consolidation period in the short term. So don't get discouraged if you see some further downside. We could see $18 silver or $800 platinum. To me, that's the buying opportunity because that's going to mark the bottom of the pullback and we're going to launch. The third leg is the biggest leg in Elliott wave and it's coming. We have to finish this pullback first before that big third leg comes. And it's going to scare a lot of people out. And I can't tell you when we're going to end. Maybe we've already ended. Maybe we haven't. We'll see. But we've been in the pullback since August for gold. And oil's just recent. Patience here because these moves are massive. They're absolutely massive moves. We're talking just like I said before, 20 baggers, 30 baggers, 40 baggers, 100 baggers, 70 baggers, 100 baggers. They're out there. We just have to wait because this is a big picture, long-term investment, 5, 10 years plus, and these things are going to go. So that's what I'm looking at. I'm showing you that they're correlated to the 10-year yield. I think that inflation's coming. It's going to put pressure on the 10-year yield. Then these things are going to roll. And the 10-year yield is going to chase inflation. And if they hold its stuff down, it's going to just wreck the dollar. Now, they can do this only because all the other currencies are weaker. So all currencies, in my opinion, are going to be weak, and everyone's going to be running at real things. So that's my opinion. They're going to be going after commodities, precious metals, and other real assets in the world, tangible assets. If you guys like this presentation, please give me a thumbs up, subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.